Hello, my name is Ian Lapey, Portfolio Manager of the Gabelli Global Financial Services Fund. I joined the firm and launched the fund in October 2018. Previously, I had spent most of my career at Third Avenue Management, where I worked with Marty Whitman as the co-manager and then successor manager of the flagship Third Avenue Value Fund. My original thesis in launching and personally seeding the fund was that post the global financial crisis, most regulated financial institutions had very strong capital positions and cheap common stocks. Since then, the thesis has been tested by a global pandemic, wars, inflation, bank runs, and tariffs. For the most part, global banks, insurance companies, and other financial institutions have been resilient. The Gabelli Global Financial Services Fund utilizes a fundamental long-term value investing approach. We look for common stocks of companies with strong financial positions and highly skilled management teams that operate with a long-term ownership mentality. We buy at discounts to intrinsic or private market value where there are long-term catalysts for closing the gap. The fund is global with a little over half of its assets in the US and significant portions in Europe and Asia, and prudently diversified with 40 to 50 positions. The fund's valuation metrics are attractive on an absolute and relative basis at significant discounts to the overall market on a price to earnings, price to book, and dividend yield basis. The fund has low turnover and has been reasonably tax efficient with no capital gain distributions since inception. Thank you very much.
Welcome to today's webinar. Thank you for joining us for what should be a very timely discussion on value investing across global financial services. I'm Gustavo Pafano, Portfolio Manager and Research Analyst at Gabelli Funds based in our London office, and I'll be moderating today's session. I'm very pleased to be joined by Ian Lapey, Portfolio Manager of the Gabelli Global Financial Services Fund, mutual fund ticker GFSIX. Ian has been managing the fund since inception in 2018 and brings over 25 years of investment experience as a specialist in global financials. For those less familiar with our firm, the Gabelli organization is a global asset manager founded by our chairman, Mario Gabelli, in 1977. We invest approximately $35 billion in client assets across equity, fixed income, and convertible strategies through open and closed-end funds, ETFs, alternatives, and separate accounts. Our investment philosophy is rooted in fundamental bottom-up research in the Gabelli private market value with a catalyst approach. We look for stocks trading at a discount to what an informed strategic buyer would pay for the entire business in a private transaction. Effectively, it's the intrinsic value plus a strategic premium. We then look for a catalyst, whether industry-driven or company-specific, that will unlock that value over time. So Ian, thank you for being here. Let's start with the investment opportunity that led you to launch this fund.
Thanks, Gustavo, and thanks to everyone for joining us today. So my background, I spent about 14 years at Third Avenue Management and was a generalist there, but did spend a lot of time on financials and frankly had a fairly mixed experience, particularly during the financial crisis. After leaving Third Avenue in 2014, I joined with some colleagues at Morris, which was an international focused value investing firm. And I was focused there on global banks and insurance companies and really was struck by how different things were compared to before the financial crisis. And the stocks were cheap. So that led me really to come up with this idea of launching a global financial services mutual fund. I pitched Mario Gabelli on the idea, and he was receptive. So we launched. I seeded the fund on October 1st of 2018. So the crux of the thesis then, and really frankly now, is that capital positions were very strong. And this slide really demonstrates that, starting with, I think the most noteworthy is Citigroup. You can see that at the end of 2007, assets to tangible shareholders' equity was almost 43 times. Now it's 15.5. So roughly 2/3 less levered now versus before the crisis. But it's not all. It's not only what the numbers are; it's also what the numbers mean, and the quality of the assets. So, level 3 assets is something we track very closely, and these are valued by the company using models based on unobservable inputs. And if that sounds scary to you, it certainly is to me. These, which at the time was mostly things like CDO squareds, accounted for 268% of Citigroup's tangible shareholders' equity at the end of '07, and now it's down to about 6%. And you can see the other banks here have similar trends in terms of less leverage and much less usage of level 3 assets, which are always susceptible to not necessarily fraud, but misvaluation.
And so how did that initial investment thesis play out or evolve since?
Yeah, well, a lot has happened, and frankly, if you had told me that we were going to have a global pandemic, a war in Ukraine, now we have a war in Iran, inflation, bank runs, and tariffs, I don't even know if I would have wanted to start a financials fund. But the performance of global financial institutions has been quite good. They've really been very resilient. So what this slide shows is that capital ratios have been stable or even improved. Loan loss reserve ratios also stable. And the companies have been very profitable during this period despite these headwinds. Citigroup has actually made $84 billion in net income over this period. Tangible book value growth has been healthy for all these companies, and many of them have repurchased shares. The one I would highlight is First Citizens, which amazingly has grown tangible book value per share by 455% over this period. And it's the largest position in the fund and really a good example of what we look for. One thing I've learned in financials is that it is extremely management intensive. So you really want to make sure you're investing with very competent, skilled management teams. So in the case of First Citizens, the CEO, Frank Holding Jr., he's the third generation CEO of this Raleigh, North Carolina-based bank. He and his family own about 13% of the economic interest, which is about $3 billion, so they have a lot of skin in the game. And the company has a history of very accretive acquisitions. They bought a bunch of failed banks during the financial crisis. Those were relatively small deals. But then in 2019, during the pandemic, they bought CIT at 40% of tangible book. The fund actually owned CIT at the time, so that's how we became First Citizens shareholders. And then in one of the best acquisitions of all time, I think, they bought Silicon Valley Bank in an FDIC auction in 2023. They paid $500 million, and in the first quarter after closing, they booked a $9.8 billion after-tax gain. So tremendous track record. The company has a strong capital position, 11% Tier 1 common versus 7% regulatory minimum, and only trades at a slight premium to tangible book and 10 times earnings. This shows what First Citizens has done since Frank Holding became CEO, and I would note this was before the financial crisis, during which they actually remained profitable. But tangible book value per share growth of 16% a year is really tremendous, and certainly the type of management team we're looking for.
Yeah, very strong execution. That is a textbook hockey stick chart. What other bank stocks do you like?
Yeah, so these are the U.S. banks that we own in the fund. And as you can see, they trade at around 10 times 2026 earnings, which I think is attractive on both an absolute and relative basis. Maybe I'll mention the second largest bank holding in the fund, which is Capital One. And again, management is so important. In this case, Richard Fairbank, the current CEO, was also the co-founder. So I believe Capital One is the only large bank still run by its co-founder. The company's been profitable every year since the IPO. Richard is very focused on long-term shareholder value. He does not give quarterly guidance, even though Wall Street analysts continually pressure him to do so. He says, and I agree, that managing to the quarter is not necessarily consistent with generating long-term shareholder value. The company has made a few acquisitions over the years, but probably the best one just happened last year. They bought Discover Financial Services. Discover, which had been running into some regulatory problems, has one of the 4 global payment networks, with the others being Visa, MasterCard, and American Express. So this acquisition should really improve Capital One's return profile going forward. Capital One has a very strong capital position, 14% Tier 1 common versus a 9% regulatory minimum, and trades at only about 9 times earnings. So here's how Capital One and Richard Fairbank have done since the IPO. As I said, they've never lost money. Tangible book value per share has grown at 14% a year, so not quite as good as First Citizens, but certainly very impressive growth, and that could actually increase going forward with the Discover transaction.
Very impressive growth. What other bank stocks do you like?
Yeah, so maybe we'll move over to Europe. And Gustavo, actually, you joined me just in December when I met with NatWest and Standard Chartered in London, and I remember you asked some good questions about fintech competition.
Yeah, I mean, Europe is a little bit of a different landscape, and there is a lot more fintech competition from these quote unquote challenger banks. So it was interesting to hear management's take on how they're competing against these innovative startups.
Yeah, and it's definitely something that we're have been watching. We haven't invested directly in any fintechs, although Richard Fairbank describes Capital One as the original fintech, as that company has always been a big utilizer of technology. So in Europe, the stocks have re-rated over the last couple years, but still trade in the high single-digit PE multiples and have low to mid-single-digit dividend yields, which is quite attractive. I'll mention the largest European bank position in the fund, Commerzbank. It's an investment that I really like because I think there are really 2 ways to win. One, they can just continue to execute their strategy. They've set a goal for 2028 of a 15% return on tangible equity, up from a bit under 8% in 23. This involves cutting about 10% of the workforce, mostly in Germany. And so far, under Bettina Orlopp, who's been the CEO for a couple years and was the CFO before that, they've done a good job. Earnings per share has grown at a 39% CAGR since 2022. So if this continues, I think as shareholders will do well. But then the other option is UniCredit, which started buying shares in 2024 of Commerzbank. They currently own 26% plus another 4% in swaps. Just a couple weeks ago, they launched a voluntary exchange offer for the whole company. Now, this was only at a 4% premium and a stock deal. And the CEO, Andrea Orcel, acknowledged that he's not expecting to gain control with this offer. However, it should enable them to get above 30%, after which they can buy in the open market. And more importantly, he's hopeful and has expressed this recently at a conference that this exchange offer will essentially bring the 2 companies to the table and hopefully negotiate something. a trend. Everyone has been saying for years that European banks need to consolidate. This would be, I think, a good consolidation because UniCredit owns the third largest bank, private bank in Germany, and Commerzbank owns the second. UniCredit is much more efficient with about a double ROE. So I think a merger could make sense. But again, if it doesn't happen, I think at a minimum, UniCredit has certainly lit a fire under Commerzbank. One of the things I think that has been helpful, and it's been a long-term trend for European banks, is just significant improvement in financial strength and performance. So this data is from the 100 or so largest European banks. And most notably, you can see that the non-performing loan ratio in 2025 for these banks was over 7%. Now it's below 2%. The capital positions have been edging higher throughout this period. And return on equity has significantly improved as well, up to about 10% now. And I would just note that during the pandemic, the companies booked very large loan loss reserves, which ended up being mostly reversed because underlying credit performance was good. So that the low ROE in 19 or 20 and 21 is somewhat misleading, or very misleading.
Mm. Yeah, interesting trends. And as you say, a market prone to corporate activity. Here we have the stocks that you're investing in Asia. Tell us about how you look for investment opportunities across the emerging markets.
Yeah, well, this is actually at least in banks, the area where we're finding the most value currently, specifically in Hong Kong. So the top three positions here are all Hong Kong listed companies. And you can see that the valuations are between 35 and 50% of tangible book, 5 to 8 times earnings. I would note that HSBC recently took private the 37% that they didn't already own of their Hong Kong banking subsidiary, Hang Seng Bank, and they did that at a price of 1.8 times tangible book. So in the fund right now, we own similar, although smaller companies that trade at just fractions of the multiple that a very sophisticated buyer just paid for a Hong Kong bank. Also, Da Sing Bank just reported earnings yesterday for the second half of 2025, and earnings per share grew by 36%. They raised their dividend by 26%. So despite these what appear to be very distressed valuation multiples, the business is actually performing quite well. There have been headwinds in terms of commercial real estate in Hong Kong and China, but as those most recent results of Da Sing's demonstrate, that has really stabilized now. So I think great value in Hong Kong banks. Bank of East Asia was a new position in the third quarter of last year. And we also own banks in Korea and Japan that are attractive. They have re-rated up to some degree, particularly in Korea, where the banks used to be at like 30 to 40% of tangible book.
Okay, so about 12% of the portfolio in those 8 positions. And here we have the other financial subsectors besides banks that you're investing in.
Yeah, so asset management is a great business, very cash generative, not capital intensive. So we've always invested in asset managers. We have a bit of a problem now because 2 of these 5, Diamond Hill and Janus, recently agreed to all cash takeovers, so we'll be losing them, certainly looking for some others. I include here BNY Mellon and State Street, which are really custody banks, asset servicers. They're bank holding companies, but I look at them more as asset managers because 70 to 75% of their revenue is fee income. Their loan portfolios are very small and high quality. So these companies tend to be much more resilient in periods of economic weakness. And in fact, in the stress test results that are done every year, these companies actually are profitable even in very gloomy economic conditions. And they trade BNY and State Street at attractive PE multiples, sort of in the 10 to 14 times range. We also own insurance companies. I'll mention the couple of the larger positions. First American Financial is the second largest title company in the U.S. The title insurance industry is a very attractive one because loss ratios tend to be in the 4 to 5% range, which is very, very low for an insurance company. The headwind currently for First American is that their business is driven by housing activity, which has been depressed for 4 years now. However, during this period, First American has remained profitable and cash generative, and has reduced their cost structure, frankly, to match the lower volume levels. And the stock trades at only around 10 times current earnings, which are quite depressed. So I think there'd be a lot of upside. And I think it's really a question of when, not if, the housing market recovers. EL Financial is a Toronto-based investment/insurance company. They own 99.5% of Empire Life, a life insurance company based in Toronto. The company is run by the Jackman family. Currently, Duncan Jackman, his dad, Hugh, founded it. Since 1969, EL Financial has grown book value at 12.4% per year. So very respectable growth rate. And the stock trades at only 63% of book. They're also doing things to reduce that discount. Periodically, they buy their own shares. They also have a lot of their investment portfolio invested in 2 closed-end funds listed in Canada that trade at large discounts and have been buying back shares. So a very attractive valuation there.
And going from attractive valuations, we know that without a good catalyst, a value stock stays a value stock. So let's focus more on catalysts in the portfolio.
Yeah, well, you're certainly right. Now, one of the things that, as you said, Gustavo, in the beginning, we try to buy below private market value. And if we do that, there are a lot of ways, ultimately, that our investors can win. If a management does a good job and closes the gap by either good business performance or some type of financial engineering, that's great. But sometimes they don't, and another party will come along and pay a healthy premium. So just in the last 4 months, we've had 4 of the 47 positions in the fund agree to takeovers. As I mentioned, Diamond Hill and Janus. These are cash deals, 49% premium for Diamond Hill, 25% for Janus. So presumably we'll be losing these positions in the next few months. The other 2 here were stock deals, or at least part stock. In the case of Flushing Financial, which is a regional bank with most of its operations in New York City and Queens and Long Island, they were purchased. They entered into an agreement to be purchased by Ocean First, which had recently entered the New York City market, but is based in New Jersey. So there's definite synergies. This is a stock deal, 100% stock. It was about a 30% premium to where Flushing was trading 2 months before the transaction was announced. However, the stocks of both Flushing and Ocean First traded down after the deal was announced, largely because this transaction will be about 6% dilutive to Ocean First's tangible book. However, this is mostly just due to accounting. Flushing's assets will have to be valued at fair value upon closing, and because interest rates have moved up, that will result in writing down the value of Flushing's loan portfolio. However, coming out of the transaction, Ocean First will have a very, very strong reserve coverage, very strong capital position. And Warburg Pincus, as part of this transaction, agreed to invest $225 million in Ocean First common stock at a 6% premium to pro forma tangible book, which is probably about 15 or so percent higher than where the stock is right now, maybe 10. So I like this transaction, even though the fund didn't benefit in the near term in terms of performance. I think longer term, this transaction makes a lot of sense. Similarly, Webster Financial entered into a sale agreement with the huge Spanish bank Santander. And even though this was only a 16% premium, it was 2 times tangible book, which is a great price, I think, for most any bank to sell at. This is about 2/3 cash, 1/3 Santander stock. Since the transaction was announced shortly before the Iran war started, so Santander's stock has fallen along with virtually every bank since then, which makes it more attractive, frankly, for the stock component that we will ultimately get if we continue to hold this. Santander is a very, very high quality bank. They generate a return on tangible equity in the high teens. They have a goal of getting that to 20% by 2028. So in all likelihood, the fund will be happy to own a position in Santander after this closes and obviously get about 2/3 back in cash. So obviously consolidation is terrific. Sometimes activism, again, if going back to what we do, which is buy below private market or intrinsic value, sometimes an activist will come along to help close that gap. I mentioned what UniCredit is doing, which has been very constructive, I think, for Commerce Bank shareholders and continues, as I said, just with the recent exchange offer for the whole company. In the case of Janus, actually, Victory Capital, after Janus announced a transaction at 49, came along and submitted an LOI to pay 59 in part cash, part stock. Now, this was going to be subject to diligence and only an LOI, but it did essentially result in Janus, or the buyers of Janus, Trian and General Atlantic, raising their offer from 49 to 52. So for now, Victory has withdrawn, but this activity by Victory has certainly been helpful for Janus shareholders. And then another one, actually a top 10 position in the fund, Trustco Bank, which is a small regional bank with operations mostly in the Northeast, upstate New York, and then in Florida. The company has a great retail, very sticky, low-cost deposit base and a very strong capital position with a Tier 1 common equity ratio that's nearly double what most regional banks have. and pristine credit quality. They mostly do residential mortgages, no subprime. Over the last 5 years, they've actually had no net charge-offs, which is quite remarkable for a bank. But this Trustco attracted the attention of Holdco Asset Management, which is an asset manager focused on financial services that takes an active approach, tries to get on boards, etc. So they met several times, starting in the middle of last year. Holdco owns a 4.8% stake. They recently discussed Trustco at an industry conference, and Trustco has responded already. They bought back about 5% of their shares last year, and announced another 11% share repurchase in December. Holdco had said specifically that given Trustco's valuation and capital position, it should be repurchasing shares but not pursuing acquisitions. So Trustco seems to be doing that, and in fact, when they made their most recent share repurchase announcement, the CEO, Rob McCormick, said the best investment we can make is in ourselves. So essentially saying, we're not going to buy anyone else when we can just buy ourselves. So I think we and Holdco both view Trustco to be a very attractive investment. We may have some different ideas as to how to create value, but some overlap as well. But generally, I'd view their participation constructively.
Mm-hmm.
And then another catalyst, and this has been going on even before in the financial services industry, even before I launched this fund. If a common stock is undervalued and the company is well capitalized with excess capital, repurchasing shares is a good idea, I think, because it increases the value of the intrinsic value of the shares for the shareholders who don't sell back to the company buying back stock, like in our case, the fund. So, I'd say more than half of the holdings in the fund are actively repurchasing shares currently. And that's a good feeling to have when we have this period, as we have over the last month, when virtually everything's been going down. It's good to know that our ownership position in these companies is increasing because they're buying back stock. Just to mention a couple here, BNY Mellon and State Street, pretty remarkable because their business is so capital generative. They've repurchased over the last 15 years both around 44.5% of their shares. So that obviously is massively accretive to shareholders because they haven't had to, essentially during this period, their revenues and earnings have grown as well. So I would also note several European banks. One thing that has changed in the last 5 years, European banks, if you think back to that slide, because their capital positions are strong, because their non-performing loan ratios are low, they've been in a position to repurchase shares. So UniCredit over the last 5 years, 32%, NatWest, 34%, Standard Chartered, 29%. So significant share repurchases, and these continue. All of these companies are currently buying back shares.
So a good mix of industry and company-specific catalysts across your holdings. And here we can see snapshots of the portfolio. Can you maybe just speak to the relevant valuation metrics and your performance?
Yeah, so on the top right, this is as of December 31st, so these numbers should be more attractive today with the fund down a few percent year to date. But the aggregate valuation of the holdings is about 11 times 2026 earnings, 1 times book, 1.1 times tangible book. I view these to be quite attractive valuation metrics on both an absolute and a relative. And by relative, I'm comparing to the overall market and or any type of financial services index. In terms of the fund's performance, and just in full disclosure, well, first of all, I'd look at the annualized since inception number. That's the one I focus on, I guess. That number today is more like 12.5%, again, because the fund is down a few percent year to date. But I'm fairly pleased with that, and it is an after fee number, and because there have been no capital gain distributions, the only taxes that investors pay are on the distribution of dividends. And so an after-tax return is probably in the 11.5 to 12% range, which I think is solid. I would just say, in thinking about performance, I really focus on protecting against investment risk, which is the risk that something significantly negative happens to a company or its financial position. What I don't try to worry about is market risk. Sort of out of my control, and I'm not a market guru by any means. So in years like 2022, when the market is down, the fund was down as well. I'm not going to be the manager that is going to be buying puts on the S&P to protect the downside, or go to 50% cash if I think the market's about to go down. So I would expect returns to be volatile, but on average, I think low double digit after tax, after fee returns is solid, and I'm certainly pleased with that.
Got it. Just looking at your country allocations here, you're just over 55% in the US. And looking at the top 10, I see you've got Toyota Motor, not immediately standing out as a financial services company. Can you highlight that one?
Yeah. So going back to when I launched the fund, and most of my family's net worth is in this fund, I wanted to have as much flexibility as possible while still being a global financial services fund. I really think of this as a value fund focused on financials as opposed to just a purely financials fund. So you can see in the top 10, there's a lot of big financial companies that you probably all know that are not here. But essentially, in the prospectus, in order to qualify, a company has to have a significant portion of its assets or revenues engaged in financial services. So in the case of Toyota Motor, about half of their assets are their lending business, auto lending business. So it does qualify. I think Toyota is, personally, I think it's the best auto company. It's certainly the most profitable one in the world. The only one that really didn't blow billions on EVs. It has about a $265 billion market cap, a net cash and investments position of $100 billion, trades just slightly over book, and 11 times earnings. So I think a very attractive investment, and certainly if I can invest in this fund in sort of non-traditional financial companies that I think are still really attractive, I expect to continue to do that. You can see home builders are 4.3% of the fund. I've been involved in the manufactured housing industry. I started out as a housing analyst focused on that sector. Cavco Industries is a large holding. They have an insurance and mortgage lending business. Yes, Gustavo, you're right. There are certainly, and I would expect there to continue to be, non-traditional financials in the fund.
Interesting way to look at global financial services. We're winding down, and I'd like to open it up for Q&A. There is a button at the bottom of your screen. I see a few questions come in. We'll give it a minute to compile some more questions, but I'll go through some of the ones that we've received. Quite a few on private credit. Do you have a view on private credit? Is this fund exposed to the private credit industry? What are the systemic implications of banks growing exposure to illiquid private assets like private credit?
Yeah, well, it certainly is a focus. In my experience and in financial history, there have been a lot of businesses that are based on essentially lending to less creditworthy borrowers. So if you think about like the banks that we've been discussing, they all have plenty of capital and they want to make good loans to creditworthy borrowers. You also have in the U.S. a very large high yield market where spreads have been very low for years. So generally, companies that are creditworthy can access low cost funding from banks or the high yield market. So private credit is sort of outside of this. So it's certainly an area to be worried about. Typically, when these businesses are launched focused on less creditworthy borrowers, they're successful in the beginning, particularly if they at a small scale. But then that success attracts a lot of interest, as private credit has. And then typically there are a lot of problems. So I don't know when sort of private credit is going to blow up, but I certainly expect it to. It could be starting now. In terms of exposure to the fund, I've been, when I'm meeting with banks and insurance companies, very focused on exposure to private credit. I think for banks, at least the ones I own, the exposure to private credit should be manageable. It's mostly secured with low LTVs, and they have generally the ability to replace poorly performing credits with better ones. I guess I'm more concerned about insurance companies. I think theoretically, private credit does make sense for a life insurance company because they have long dated liabilities, so they shouldn't really need the liquidity. But still, you never want to make a bad investment, no matter what business you're in. So I own Aegon and NN Group, and both have a fairly modest, but it's certainly something I'm watching, exposure to private credit. One of my newest investments of an insurance company is Old Republic, which I initiated the position in the third quarter of last year. And one of the things I really like about it is they're very clear in their 10K that their investment portfolio does not have any derivatives, private equity, private credit, hedge funds, venture capital. So it's or high yield, even high yield bonds. So they're basically invested in investment grade credit instruments and then common stocks of profitable companies that pay dividends. So I really like this and certainly plan to continue to focus on companies that are very prudent. And it gets back to talking about how management intensive financial services is, because there are always going to be these areas of froth and you really have to avoid them. And I feel like we've done a pretty good job in the fund so far, but it's an area to watch.
Sure. Question on FX. Since you're investing globally, does this fund hedge against its foreign currency exposure?
We have not to date. In the initial years, currency was a headwind because the dollar appreciated. The euro is our biggest exposure. The last couple years, currency has been a tailwind. Year to date, it's a bit of a headwind. Net, probably about a wash, which is one of the reasons I don't hedge, because as a long-term investor, there's always a cost to hedging. However, I would consider it if we had a significant exposure to a currency that seemed, frothy, overvalued, and I'm not a currency expert, but I can remember at Third Avenue when the Brazilian real was really, really inflated, that it was something that we worried quite a bit about. For many of the holdings, though, there's a bit of a natural hedge. So for Toyota, for example, a weak Japanese yen, all other things being equal, will hurt the performance of our investment. However, it does also help the auto business, making them more globally competitive. So for a lot of the exposure, there is, somewhat of a natural hedge. But so short answer, no hedges to date. We could do it, but I'm not a currency expert, so it would probably have to be something really a risk management issue.
In the essence of time, I think we'll stop there. Thank you, Ian, and thank you to our audience who joined the webinar and submitted questions. If you'd like to learn more about the Gabelli Global Financial Services Fund, please reach out to your Gabelli representative. Visit www.gabelli.com or follow the link from our QR code here. We appreciate your time and interest, and we look forward to speaking with you again. Thank you and goodbye.
Thank you. Thanks, Gustavo. Thanks to everyone for joining us.
Ian Lapey is the portfolio manager of the Gabelli Global Financial Services Fund. Returns represent past performance and do not guarantee future results. Due to market volatility, current performance may be lower or higher than the performance data quoted. Investment return and principal value will fluctuate, so upon redemption, shares may be worth more or less than their original cost. To obtain the most recent month-end performance information and a prospectus, please call 800-GABELLI or visit www.gabelli.com. Funds concentrating in specific sectors may experience greater fluctuations in value than funds that are more diversified. Investing in foreign securities involves risks not ordinarily associated with investments in domestic issues, including currency fluctuations, economic and political risks. Not FDIC insured, not bank guaranteed, may lose value. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. The Gabelli mutual funds are distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.